Cool, cool. And then Joey is just he's on the Wolf team. He's just been helping me out with different stuff. He's just gonna be chilling.
Okay.
Yeah, how's your day going?
A little red today, but that's all right. Last couple days have been pretty good, so I guess this was bound to happen. I'm actually surprised the markets digested that CPI number and the PPI number today as well as they did right off the bat. So maybe just a late reaction.
I mean, it was right at expectation, right?
What CPI or PPI?
I guess CPI.
Yeah, yeah, but I think the night before the White House. I don't know if they put out like a press release or if it's just some White House spokesperson said something like get ready for a pretty bad or pretty big inflation number. So I just think people were coming into that CPI number expecting something a lot worse than 7%. So I think 7% sort of looked like a relief, which is kind of crazy because I don't think any of us feel like 7% is a relief, but maybe this is the top. Hopefully it is.
When do we get back to getting like 17% on our bonds, like in the 70s?
Probably no time soon.
Yeah, we just get all
Even
the
the
cash,
economists are
none of the
saying
good
we
stuff.
might get to 2% by the end of this year or in like the next 6 to 9 months. I mean, historically speaking, 2% on the 10 year is still very, very low. So, I don't think the 10 year going from here up to 2% needs to, destroy equities or growth stocks for that matter. But, it's sometimes the velocity and how fast it goes up, that causes these big sell offs. So, but it looks like we're getting a little bit of a bounce right here. I mean, at least I don't know. My portfolio looks a little bit better now than it did an hour ago or a couple hours ago. So where would you like to start?
Good question. So first, I think we could start. I mean, we just kind of touched on it, but right now, I think we can work our way down from maybe starting with just like the overall macro environment. Like growth stocks have now been kind of falling for 2.5 months straight, pretty much. A lot of these things have been chopped, 50, 60, 70% off their valuations. Maybe just start kind of that macro picture right now, like first what's going on, and then if you want to walk through, start with some of your largest holdings.
Yeah, I mean, I'm not a great macro guy. I never have been. I never will be. I mean, I obviously follow the stuff mostly interest rates and inflation numbers now, obviously. But I don't know what the Fed's going to do. I don't know when they're going to raise rates. I mean, it seems like they're sort of setting the stage right now for a possible rate hike in March, and then I think the next one would probably be May, and then maybe September. I'm not 100% sure. I haven't looked at that dot plot, but most likely we're going to get at least 3 rate hikes this year. I know a couple people are saying 4. I'd be surprised if they did 4, but I just have no idea. And then I just have no idea what's really priced into stocks right now. I mean, if they ended up doing a rate hike in March, I mean, is that already priced into, you know, the current multiples and how much things have contracted in the last 2 months? Or, do the multiples have to contract further because only 2 rate hikes are priced in, and then, 3 would be a negative surprise. So it's just really hard to know. I mean, I regret not raising more cash, obviously, in November going into Q3 earnings. So, I mean, I was having a really, really good year, and I didn't finish the year as strong as I would have hoped because I was just too heavily invested in growth stocks like Upstart and Celsius and CrowdStrike, and a lot of those names got absolutely hammered. I got stopped out of some of them in early December. I got stopped out in some in late December. I got stopped out of some in early January. So, I was raising cash for a little while because I wasn't adding to any positions. I wasn't selling my positions fast enough, but I certainly wasn't adding to anything. I don't think I bought any stocks for 5 weeks, almost 6 weeks in total. And then I started to adding to some positions maybe a week and a half or 2 weeks ago, probably even less. Yeah, probably a week and a half ago. And I've been adding a little bit more aggressively the last couple of days. I've started a couple new positions. I got into Shopify for the first time in like a year. I think yesterday, the day before, the stock's fallen 40% from the highs. It's still a phenomenal company. Whether or not it ever makes to $1 trillion, I have no idea. But Shopify, the multiples obviously come way down. If they can grow revenues by 35 to 40% for the next 4 or 5 years, which I think they probably can, and grow earnings at a similar rate, this is a company that could do, by 2025, they could be doing 15 to $20 billion a year in revenue. But so, I'm just looking for opportunities like that. But, over the last couple months, given what we've seen in, talk from the Fed and the rotation into value, I'm not ready to go hardcore value all the way. But I did transition part of my portfolio to, more traditional value slash cyclical stocks. So, my largest position right now, my portfolio, and it has been for the last 2 weeks, I guess is XOP, which is an energy ETF. It's the smaller, not small caps, not even mid caps. I mean, most of them are large caps by definition, because large caps are technically over 10 billion market cap, but it's not like the large major integrateds like Exxon, Conoco, and Chevron. If you buy XLF, I believe those three, or at least Chevron and Exxon, dominated. I think it's like 30 to 40% of the ETF is those two alone. So I didn't want that much exposure to the big ones, even though they've actually done a little bit better year to date than the smaller ones. I decided to go with XOP instead. So that's actually my largest position right now. So I mean, that's pretty defensive, I guess. I mean, obviously not a growth stock. And then if you go down, my second largest position right now is Zim Shipping. I've been in Zim for probably 6 or 7 months now, since the beginning of the summer or late spring, when the stock was in the 30s or low 40s, and I've been adding to it pretty consistently. It broke out yesterday above 62. Got up to about 64.50 today. Let me see. Yeah, it's still trading in the 64. So, I mean, this has been just a phenomenal stock the last. Well, I shouldn't even say the last few months. I mean, it kind of did nothing for a few months. Actually got down into the mid 40s back in mid December. So it's up almost 50% in the last 4 or 5 weeks. And it's still cheap. I mean, very cheap on earnings, cash flow. I mean, they should, they pay a ridiculous dividend. They just paid a 250 dividend for Q4. They're going to pay probably a $12 dividend sometime in the spring for all of 2021. And then they're going to be doing a 20% payout out of quarterly net income. And that could be another $2 a quarter on top of the 12 that's probably coming for 2021. So they could pay out something like $20 next year in dividends, for a $60 stock. I mean, you do the math, and that's a ridiculous dividend yield. So, um, if I go down my portfolio, like, I still do own some growth stocks, but for the most part, they're all profitable companies. I've gotten out of all of my small caps. I've gotten out of all of the unprofitable growth stocks that I owned for most of last year, when, we had QE kind of backing us up. And now that QE is no longer there, or at least there to the same degree, I just don't want to be in these unprofitable growth stocks right now. At some point, they'll probably bottom out. Maybe they'll look really oversold or start to look reasonably priced again, and maybe I can jump into some of them. But for the most part, I'm sticking with profitable growth stocks in certain sectors. Like, I'm definitely overweight semis, cybersecurity. I'm just looking at my portfolio right now. I guess I don't know what you call Crocs, like consumer discretionary. So a name like Crocs. So I sold Crocs maybe 3 months ago, up in the maybe 160 or 170 range. And I think the stock got up to 184, and then it pulled back with the growth stocks. And even though this is a profitable company, that's growing revenues by 25-30%, growing earnings by 25-30%, trading at a reasonable multiple, PE ratio, the stock still got hammered. And then a couple weeks ago, they announced that they were buying a company called Hey Dude, which I never even heard of before, but it's another casual footwear company like Crocs. The stock got absolutely pummeled. I think it was down like 18 or 19% on the day, down under, I think it got down to about 118. So I went in and started a position again, because at that point, and that was after management basically said that the acquisition of Hey Dude, and I think they paid $3 or $4 billion for it. I mean, it was a decent sized deal, but I think they said Hey Dude's going to do somewhere around 750 million in revenue this year. They're very profitable. They're growing fast, and the acquisition would actually be accretive to earnings. So the analysts all came out immediately and defended the stock, kept their price targets. So Crocs should probably do at least $11 in earnings this year, 2022. So the stock's selling at like, I don't know what is 12 times earnings, maybe, with 30. I mean, and now they're going to do 35% revenue growth for the year, although some of that's obviously coming from the acquisition. So there's, probably a larger share count. But anyways, it's just, those are the types of stocks that I'm trying to own right now. Still have significant growth, better than average. Same with earnings, and then trading at reasonable multiples. So Crocs, Qualcomm, Micron, Nvidia is a little bit expensive if you look at the PE, but obviously one exposure to semiconductors. AMD is another position, and then I have CLF, Cleveland Cliffs, which is a steel company, Disney, Dutch Bros, which was a recent deep dive write up of mine. That's a coffee chain. So they came public back in was it March? I'm trying to remember now. When did they come public? Hold on. I've done so many write-ups. I just finished another write-up on DigitalOcean, which I'll get to in a second. I should make sure I have Bros. I think Bros is September, actually. Yeah, September. So, I mean, this is a company that started off 30 years ago in Oregon, started by two brothers. Unfortunately, one of the brothers, passed away a few years after that. But, they literally started with like an espresso machine and a push cart. And over the last 30 years, they've expanded through the Pacific Northwest, down the West Coast into the Southwest, meaning New Mexico and Arizona. And then now they're in Nevada, Utah, Colorado. They've expanded into Texas. And they were doing franchisees for a while, but they actually decided a couple of years ago that they're not going to franchise anymore. They're just going to do 100% corporate owned stores. So, they're now at 530 stores. So a couple of days ago, they actually just pre-announced their Q4 results, and they said that they'll be at the slightly better than the higher, the high end of expectations or guidance. And they said that as at the end of Q4, which I guess is the end of 2021, they're now at 530 stores, and they're looking to open, I think it's 125 stores in 2022. So management has already set a goal for 4,000 stores in total. And if you they're going to have to accelerate their growth if they're going to get there in the next 10 years. But, I think in the next 10 to 15 years, they would have a shot at getting to those 4,000 stores, because obviously their plan is to expand through the Midwest, and then eventually to the East Coast. And, they're sort of, they're not, they're definitely not Starbucks. I don't really know if they even compete with Starbucks. It's such a different business model because it's primarily drive through. I guess you could say walk up, but drive through. Like it's not like Starbucks where they have this nice, ambiance. I can't even say the word right now. Like a nice sit down environment inside where you'd want to go into Starbucks, meet a friend, meet a business associate, sit down for an hour and a half and have some coffee. That's definitely not Dutch Bros. Dutch Bros is definitely more, they call themselves like fast casual, I guess, but it's really like drive through, order. So they don't actually have mobile ordering right now, which blows my mind. They're trying to get, so they have an app, a mobile app, for ordering and rewards, but I believe it's ordering like when you get there. I don't think they're doing any, to go ordering or like, like order ahead like you can do with Starbucks and Dunkin' Donuts. I live right across the street from a Starbucks. I can sit in my apartment, I can order my drink and then walk down there in 10 minutes and pick it up. It's perfect. Dutch Bros, I don't think is really doing that yet. And I have my suspicions why, because if they really drive up, how do you have all of these cars where some people have ordered ahead and some people haven't? And I can see where that would be a little chaotic, but hopefully they'll get to that point, and they're going to have to. If they want to keep growing through the Midwest and the East Coast, they're going to have to do mobile ordering at some point. So, it's an interesting company. It could be a growth story for many, many years. The valuation isn't wonderful. It's not a cheap stock by any stretch of the imagination, but it's one of these companies that should be able to grow revenues by 30-35% for the next 4, 5, 6 years. Another company that I've been adding to the last few days, DigitalOcean. So I got out of DigitalOcean back around Q3 earnings. So I got in around 50. I got out around 95. I wasn't really impressed with their Q3 results. They didn't blow away expectations, and I thought the valuation, the multiple had gotten a little stretched. Where if they didn't beat by a significant number, the stock would sell off, and it actually did. And I actually felt smart for a few minutes because I think it was down 7 or 8% right after they reported, and then within I don't know if it was that day, the next day, or a couple of days later. I mean, the stock had rebounded and was up. The stock rallied over the next few weeks from the low 90s all the way up into the 130s. And then if you look at the chart on DigitalOcean, I mean, that thing's basically been straight down for the last 2 months. So, I mean, it went from 133 back on November 19th. I mean, there was like a really ugly, almost a 20% down day on November 22nd. And then on December 1st, I mean, that looks like another 10 or 15% down day, through, I mean, basically today. Well, I guess technically 3 or 4 days ago is when the stock bottomed out at 65. I got in right around there. I think maybe 66 is where I jumped in, and then I've added a couple times the last few days. So if you throw on the 200-day moving average, so just over the last few days, you've been able to pull up the 200-day moving average on DigitalOcean. Right now at like $67, it is sitting right on top of the 200-day moving average. So obviously, I'd like to see this hold. If it can't hold here, I'd obviously like to see that 65 hold from a couple days ago. But I think at these prices, I mean, this is a pretty attractive valuation for this company. So they should do, I don't know. I mean, I think right now the consensus estimates for 2022 are about 563 million in revenues and about 72 million in net income. So, price to sales right now, the enterprise value, I believe, is around 6.8 billion. So divide that by, the expected revenues for this year, and the stock's now trading about 12 times sales. And revenue growth for this year is expected to be, I think, 32 or 33%. But if you look at the consensus estimates, the analysts are already projecting at least 30% growth through the next 4 years. So 2022 through 2025, they're expecting at least 30% revenue growth each of those 4 years. I think the average is around 33 or 34%. And then if you look at earnings growth, they're actually expecting even stronger earnings growth. I believe the average over the next 4 years is 67%. So, even though the stock right now, if they only do 72 million in net income for this year, the stock's technically trading right now at like 90 times earnings. And I get that's a little expensive, but if they're going to grow earnings this year by 85% and then another 80-90% next year, that PE multiple, looks pretty reasonable. So, it's one of these stocks that's going to grow at least 30% a year and has at least 30% EBITDA margins. And whenever I run my screens, there's not that many companies outside of like energy and Bitcoin mining and what else? Shipping. There's a few industries where, you get a lot of those companies coming through. But when you get into, the typical growth sectors like software, cloud, et cetera, there's not that many companies that meet that criteria, 30% revenue growth and 30% EBITDA margin. So, I try to keep an eye on those stocks, other ones that meet that criteria, MP Materials, D-Lo, which is D-Local, another one of my top holdings, Zoom Info, which is ticker symbol ZI, App, APP, that's App Lovin', and IS, which is Iron Source, which is actually a stock that I got into yesterday. And that's one of the reasons why. The fundamentals are just really strong. The stock's been absolutely pummeled. This was a SPAC by, I think it's Thomas Bravo, I believe is the name of the company that took them public via SPAC. And the stock's been absolutely cremated. I bought in yesterday around like 690, add a little bit today around like 675, 680. It's still a small, I think it's like a 1% position in my portfolio, but I want to dig into this company more. I have a couple friends in Israel that speak very highly about this company. They're part of like the app economy and helping developers monetize their apps. So I'm definitely not an expert in this name, Iron Source, but the fundamentals are hard to ignore. And another one I added on fundamentals is what is it? Hold on, let me just pull up there. So it's four. Make sure I get the company. Shift. I think Shift 4 is the name of the company. Hold on, make sure I say it right. Yeah, Shift 4 Payments. So I was actually in PayPal recently. I got into PayPal like a week ago, trying to pick the bottom. And then once I stumbled across Four, and Four had come through some screens before. I had a couple people in my DMs pitching me on this company over the last couple months. I've started to dig into it. Very interesting company. They do a lot in like the hospitality, casino space, but once again, just really, really strong fundamentals, reasonable multiples. I think the stock's trading at like 35 or 36 times earnings, with at least 35 or 40% revenue growth and earnings growth. So another stock I'll talk about is Celsius. So Celsius has obviously pulled back from the highs, like way off the highs. I think today at the lows, or maybe even right now, the stock's trading 54% off the all-time highs of about 110. So I sold about a third of my position around the highs. I got stopped out of another third around like in the 80s. And then the last third, I got stopped out in the low 60s, I believe it was. And then a couple days ago, there was a filing from the largest shareholder, this guy out of China. But he's an older gentleman. I think he's in his 70s or 80s now. Multi billionaire, is actually one of the richest people in China, and he owns well over $1 billion of Celsius stock, personal holdings, and then I think he also has some in a trust or foundation. And he registered like a huge percentage of that position, those shares, and the stock took a nosedive because of it. But I don't believe he's actually filed yet to sell any shares. I think he's just registering them. And I know a couple of people that follow the company closely. They've talked to investor relations, and it sounds like, he's just registering them so he can use them as collateral or margin. I don't know. I don't know how much of that is true, but I don't think he's filed to sell anything yet. So I don't think there's any reason to necessarily panic. I also think that that's now priced into the stock at these prices. So, Celsius right now is trading at 51.14. We had a high of like 110. I think pre-market when they announced Q3 earnings, the stock got up to like 115, maybe, if I remember correctly. I probably should have sold everything then, but I mean, I still have conviction. The fundamentals are still phenomenal. Celsius, they beat their Q3 estimates by 30%, and then the stock dropped 54%. So, I mean, you can doesn't take a genius to know that the multiples obviously contracted significantly since Q3 earnings, and that was just 2 months ago. So they, for 2021, they'll probably end up doing around 310 million total revenues, and that would be about 138% year over year growth from last year. Now compare that to Monster, which is only growing 18% year over year. So Celsius is growing at about 7.5 times faster than Monster. But Monster's now trading, they're both trading at about the same price to sales multiple. Now, Monster does have better net income margins because they're obviously a more established, more mature company. But if you just go off price to sales, which is somewhat fair, because even though Celsius has seen their margins decline over the last year, most of it was related to the supply chain problems. And then they made some significant investments in Q3 that should help alleviate some of those problems. So we should start to see the gross margins for Celsius tick up as we get through 2022. So I think we'll get back into the mid 40s, hopefully by the end of this year. Monster's in the mid 50s on gross margins. So, I mean, we still have a ways to go. But, in terms of, so they're both trading at about 8 times sales. Right now, the analysts are looking for 488 million in total revenues for 2022. I think the company has a chance to blow that away and maybe do something closer to 550 or 600 million in revenues, which would obviously be, almost 90 to 100% year over year growth, assuming they do 310 million this year. And the reason I say that is if you just look at the recent sales data. So Gary Black, who, he's also a big Celsius shareholder. He shared all the sales data a couple days ago. I retweeted it. So, or shared it. So if anyone is just curious, what that data is, feel free to go to my Twitter account and look it up. I'm just going to pull it up right now so I get the numbers straight. So January 11th, so 2 days ago is when I tweeted it. So prior 12 weeks, which is basically all of Q4 for Celsius, year over year sales, and this is brick and mortar basically. So these numbers don't include Amazon, so I have to wait to get the stack line data in order to see the Amazon sales, and then that'll help me come up with my Q4 estimates, and I'll probably be able to do that in the next week or so. But so brick and mortar, this is retail sales basically. So this is, Walmart, Target, Costco, 7-Eleven, CVS, Walgreens, etc. They grew Q4 year over year 224%, which is ridiculous. If you look at Red Bull, Red Bull's at 17.1% year over year. Coca-Cola's at 11, Monster's at 8.6, Pepsi's at 10. So Celsius is like not even in the same universe with these companies. I mean, what they're doing compared to their peers and the category as a whole is just unheard of. I've talked to some beverage experts and they've never seen anything like this. Now, of course, Red Bull and Monster have a much larger revenue base, so it's obviously a lot harder to grow, off of 6 billion or 8 billion or 10 billion. But, just in terms of like absolute numbers, Celsius is crushing it on the revenue growth side. And then if you look at the last 2 weeks, they're at 244%. So if they were at 224% for the whole quarter and they're at 244 going into year end, that means that they're actually accelerating their growth through, into the end of the year, which makes me think that they're going to get off, they're going to start off 2022 in a very strong position. And what I've been saying for the last 6 months is, the reason this story keeps on going is because, first of all, they only have like 1.5% market share. So, there's, this is a 20, 30, $40 billion TAM, and they have 1.5% of it. So there's, a long ways to go. But just in terms of them specifically, they've been adding all of these DSD partners. A couple of years ago, they were strictly or almost exclusively DTR, which is direct to retailer, which means that they had to ship product to the retailer's warehouse. Like, let's say it's Costco or Walmart, they're shipping to their distribution centers, and then the distribution centers are shipping to the stores, and then the employees are stocking at the end of the day. There's just so many things that can go wrong with that. So what they've done over the last year and a half, they've done a really nice job of transitioning to DSD, which is direct store delivery. This is how all the big boys play in the industry. And once Pepsi acquired Rockstar and then took on Bang as their exclusive distributor, that opened up the door for Celsius to go work with all of Bang's distributors, which was primarily Anheuser-Busch. So now Celsius is working with like a couple hundred DSD partners, mostly Anheuser-Busch, and that's why they're able to, increase this sales velocity in these stores and bring on so many more locations and then also bigger retailers, because now they have the DSD partners where they can fulfill those needs. So I think, going into through Q3, I believe they got up to 120,000 authorized locations. It might be it might be 130. I'd have to go back and double check, but they're not in all of those stores yet. Those are like technically authorized locations. Now that we get into 2022 with, stores doing their new resets, that now I think we start to see more stores actually carrying Celsius, and then the stores that have had success with Celsius are going to be adding more shelf space and also more cooler space. And that's important because a lot of these energy drink sales are done out of coolers in like high traffic locations, drugstores, gas stations, convenience stores, where people are going in, they're grabbing it, they want it cold because they want to drink it right away. That's where Celsius is going to start to get more cooler space, exposure, branding, etc. So it sucks the stock is sold off. Yep. But I just don't think this story is anywhere close to being over. I think there's a lot of reasons to remain bullish on Celsius, because not only are they growing retail sales by 244% year to date or year over year, but the multiple has come down to where the stock is now trading at less than 8 times sales. And if they end up doing closer to 600 million in 2022, it means they're actually trading at almost like less than 6.5 times sales. So it's just still a phenomenal company. I still drink a couple Celsius every day. I think a lot of people on Twitter have become big fans of the company, not just the stock, but they like the product. So, Celsius is now, back to being a top 5 or 6%, top 5 or 6 position in my portfolio. So, whew, running out.
On Celsius, one thing which I'd point out right here is if you take that anchored view up from the March 2020 lows, we just kind of tapped it back on the 10th. So it broke through it, but then it closed above it. And now it's sitting right above it. So that's right at the 47.55
Oh
level.
yeah,
Is that around where you have a stop?
I don't have a stop on it anymore. Nope. Nope. Because I wish I had been more aggressive with my stops, after Q3 earnings or going into Q3 earnings. I got stopped out of a few stocks. Yeah, that saved me a little bit, but I just I wasn't aggressive enough with them. So I did go through a big sell off in some of my positions. And, in some cases, I got stopped out after a 20 or 30% sell off, which I guess I wish I gotten stopped out after a 10 or 15% sell off, but some of those stocks went on to, correct another 20 or 30% after I got stopped out. So, now I'm just getting back into those positions and where I'm getting back in, I just think these stocks are now cheap enough where I have no interest in getting stopped out. So, Celsius, could it go to $40? I suppose. But, trading in the low 50s after seeing, so I'm saying this mostly because I saw their sales data for Q4. I don't think I would have remained quite this confident if I hadn't seen that data yet, because of course, like everyone else, I'm worried that eventually the sales are going to slow down, and then that's what's going to cause the multiple contraction. Obviously, in the case of Celsius and many other stocks, it had nothing. This correction had nothing to do with actual fundamentals. It was all based on multiples and valuation. But at $51 a share, enterprise value of 3.8 billion, expecting, at least I'm expecting well over 500 million revenues this year. It's too cheap to sell now. So now, I guess if the Chinese shareholder, I forget his name's like Li Shring Ra or something. I don't know. I can't pronounce it. If he, for some reason, registered all of his shares and it looked like maybe he was going to dump them all and the stock hadn't moved yet, yeah, maybe I would sell my position and try to get ahead of that. Wait for him, wait for others to catch up and then jump back in after the stock got hammered. But I don't know. I'm just sort of guessing right now. If that doesn't happen and the stock stays around here, I'm more than happy to hold on to it and just keep adding.
Got it. Got it.
Same
Sounds
thing with
good.
like DigitalOcean. Like I don't have a stop loss in DigitalOcean right now because I think in the mid 60s, the stock has gotten cheap enough where I'm not going to try to get too cute and get stopped out at 65 and then hope it falls to 62 and then I can jump back in at 62. Like I don't know, that's a tough game to play. So I think once you get into a stock and you're really really comfortable with the valuation, I got into Iron Source yesterday at like 680. It's gotten so cheap that there's just I don't want to get stopped out of it. It could go to 5, but if that happens, I guess I'll just keep adding. I still have some cash available, um, so I'm just trying to think. Like I've stop losses on some of my value stocks and ETFs that have done really really well. So, XOP, I have a stop loss on it at 100. Um, what else? Just looking through FAS. So FAS is a leveraged bank ETF. I have a stop loss on that. DPST, which is a leveraged regional bank ETF. I have a stop loss on that. So, so the energy and the financials that have all done very, very well year to date, I have stop losses on those because I don't want to give back those gains.
Okay. Yeah, that makes sense, definitely. All right. So I see that you've been doing a good amount of adding today, it feels like. Last time we had chatted, which I think was about a week or two ago, you had mentioned that you hadn't really been making ads for several weeks. Are you kind of feeling like we're now hitting a point where you're more comfortable adding capital to the market?
Yeah, a little bit. Like I said, I finally got back into Shopify for the first time in almost a year. What else did I do? I got stopped out of Crowd a couple weeks ago. I got back into Crowd this week. I got stopped out of C Limited a couple weeks ago. I got back into C Limited this week. I've been adding to D Local. D Local is one is like one of these rare companies that similar to DigitalOcean, that 30/30 club I talked about, the 30% revenue growth and 30% EBITDA margins. D Local even blows that away. D Local's growing. They're growing triple digits right now. That's obviously going to slow down next year. I think they probably have a shot at doing 70 to 80% revenue growth next year, including earnings growth. So, that's just a stock that is growing very fast and very profitable. And then they could also be an acquisition target for like a Visa, MasterCard, PayPal that want to grow, that want that international exposure, because dLocal is really, I mean, they help mostly US based enterprise companies and streaming companies, digital media companies sell their products and services in emerging markets by handling all the payment stuff. So, this is sort of maybe a less risky way for someone to get some emerging markets exposure. So Netflix, Microsoft, Lululemon, Nike, like these are all big customers for dLocal. So that's a favorite stock of mine. It's very volatile. I mean, this thing, it's actually flat today, but I mean, this stock seems to move 4, 5, 6% in both directions most days. So, don't feel like you have to chase it. See if it maybe pulls back under 30 at some point. But it's a stock that I'm just really bullish on, and I think the valuation is very, very reasonable because they have like 35 or 40% net income margins. Let me just double check. dLocal. Just make sure I get my numbers right. Yeah. So okay. So this year they're expected to have 30 to 31% net income margins, 67% revenue growth. Although there's obviously a chance that's too conservative. In mode, medical device company. So I got stopped out of that one a couple weeks ago. I got back in. Once again, I mean, this is a company that their growth is slowing down. Maybe they'll grow 25 to 35% this year, but they have incredible margins. I think they're in the 40s. Let me just double check. 48. So they're expected to have, so 2021, they're expected to have 48% net income margins. This year, they're expected to have about 42% net income margins. So, these are the kinds of stocks that I'm definitely leaning towards right now. Slightly slower growth than like the hyper growth stocks, some of the software names that are still growing 50, 60, 70%, but, they're still losing money. I think in this market with, the Fed sort of acting as a headwind and, interest rates going up at some point, I'd rather be in these slightly slower growing companies that are already generating earnings and free cash flow.
Definitely makes sense to me. Okay. So we've kind of touched on, I think, a lot of what's within your portfolio and some of the other opportunities. Now, I know we wanted to take, since we're kind of at peak audience here, a minute to talk about Fintu Conference that's coming
Yep.
up. So just wanted to give you a few minutes to share on that.
Yep. So obviously a lot of people know that we did a conference back in October down in Orlando. It went great. We had about 230 people there, or I guess we had about 230 tickets sold. I think we got 215 or 220 people there. But anyways, great turnout. I think everyone had a really nice time. It was great to finally meet people in person and put some faces to names. So we're going to do another one in May. We already have everything booked and reserved. So it's going to be May 12th through Sunday, May 15th. So the May 12th is a Thursday. So Thursday to Sunday, May 12th to May 15th at Aria, which is a really, really nice hotel and resort on the Vegas Strip. So if you go so the website is set up. Let me just double check the URL. I think it's FinTwit 2022. FinTwit. Hold on, I'm trying to do this in one hand. FinTwit 20. Yeah. Okay. So FinTwit 2022 is the website. If you can sign up, you can give us your name and email address, and then we'll send you any updates as we have them, like tickets whenever we start selling tickets, which will be sometime next month, most likely. And then there's also a link on that landing page to reserve your hotel room. So we have 350 rooms blocked off at Aria at discounted rates. As you can imagine, booking hotel rooms in Vegas on the weekend, post-pandemic or hopefully post-pandemic, is a little bit more expensive than during the week. But we did a decent job at negotiating these rates. I think we have Thursday night's rate at like 130 a night maybe, and then Friday and Saturday I think are like 300 a night. So I know it's a little bit more expensive, but I think those rooms are going for like 400 a night otherwise. So it's still a little bit of a discount. The reason that we're saying Thursday to Sunday, so I don't know if we're actually going to have any events on Thursday. I don't think we're going to, or nothing planned and organized. It's just that we're going to have a ton of stuff on Friday and Saturday. So I'm telling people to try to fly in Thursday night if you can, so that you're there all day Friday and Saturday. So Friday is going to be like a lot of panels, fireside chats. We might have some sort of a trading competition and just a bunch of other fun stuff. And then Saturday, we're going to have the general session. We're going to have, so we have the entire ballroom for the whole weekend. I think it's like 100,000 square feet. And they're going to run, a divider down the middle so that we can have two separate rooms set up with a stage on each side, with all the AV, the recording, the lights, the screens, like everything we did in Orlando, but basically times two. So that way we could have two speakers going on at the same time, but we could have one room focused more on, technicals, trading, and then the other room will be more investing, fundamentals, and that way we can try to appeal to a larger audience. I think when we did the Orlando event, it was definitely more, traders that were on stage talking, and I think anyone that's like, considers themselves more of a long-term investor, fundamentals, like digging into research, etc., looking at valuations. I think they felt like there wasn't quite enough content for them. So we're going to try to change that this time and, bring, hopefully more content for a wider audience. And that'll all be, hopefully recorded like we did last time. And then for anyone that can't make the event, we'll hopefully put that recording online again.
Perfect, perfect. Yeah, I think that covers most of it. And then, of course, we are, if you're in the audience and you are running a company and your target demographic is, people on FinTwit, there's going to be plenty of people there with, large audiences and all that. And we are looking for sponsorship. I think you just touched on that. Do we want to just go over like for 2 minutes just what the sponsorship
Yep.
looks like?
So it's going to be pretty similar to Orlando. You're going to get most of the same stuff, but you're going to get more exposure because there's going to be more people there. And we're going to have, the ballroom for 2 or 3 days. And we're going to have all the events, all of the panels, all of the breakout sessions, all of the roundtables, all of the fireside chats. Everything's going to be in the ballroom in one of these, rooms that we set up. So the sponsors will obviously have their tables in the ballroom. So, anytime we're doing events in the ballroom, which is going to be all day Friday and Saturday, these sponsors will obviously get all of that exposure, but they'll also get, all the other stuff, mentions on social media, email blasts. We'll probably do some spaces events with some of the sponsors. We'll probably do, we're going to do handouts again, like brochures at the event. I'm looking into maybe doing T-shirts as well. If I can get a reasonable price for 15 or 20 logos on the back of a T-shirt, we'll try to do T-shirts this time. Obviously, the video, like what we did last time, that worked out really well was we had, because we're in those two rooms eating breakfast and lunch on Saturday. We allowed all of the sponsors to take turns getting up on stage and doing what we call a power pitch, 4-minute power pitch about their company, because we have the entire AV team from Encore in the room the entire day. So that way they can record all of those pitches. And then when we do the final video edit, we can have them, splice in all of those different power pitches throughout the entire presentation. So if we have 8 or 10 hours of content, from that day, all of the speakers, we can stick those power pitches inside of that final video and give them some extra exposure. And then some other stuff that we're working on. I mean, we'll do whatever we can to add value to the sponsors, because obviously, they play a big part in the success of this event. And, we're going to have, I mean, let's say we have 450 or 500 people, all of the costs between, the food and beverage, the cocktail party, room rental fees, the AV, and like 50 other things, probably adds up to $400 a person. And we're trying to keep these tickets at $200. So the sponsors are basically picking up half of the total cost. So without them, these tickets would be $400 a person instead of $200 a person.
Yep, I think that's perfect. And if anybody's in the audience and is interested in sponsoring, you can obviously reach out to Jonah, or you can go ahead and DM myself. I'd be happy to help you with that process as we go towards it. We're going to have a lot of amazing speakers, obviously, from FinTwit, um, probably some from last year, as well as many new. Okay, with that being said, I think we can hop back into this stock talk for a few more minutes. Uh, Jonah, have you so it's gotten only more and more popular. You still haven't ventured at all into any crypto or anything along those lines, right?
Nope, not yet. I mean, I don't. I mean, not crypto directly. I've never owned Bitcoin or Ethereum. I've owned CoinDesk, and I still own Silvergate Bank. So that's sort of how I'm playing crypto, I guess, is with these, the companies that support it. The trading, the lending, etc. But
Awesome.
we'll have,
Thank you.
actually, it's a good segue. So we are going to have, so a lot of the panels that we have on Friday are going to be some of these other topics where, if a topic doesn't really fit into like, fundamentals or technicals, it's one of, crypto, NFTs, these other topics, different strategies, shorting, options, running a long short strategy, those sorts of things. Those are the kinds of panels that we're going to have all day Friday at the conference.
Yeah, definitely. We'll be bringing in plenty of people that have a lot of expertise on those topics. Okay, so bringing it back, can just throw a few more individual stocks over to you to get your thoughts on these. We'll probably run for at least another 15 minutes. Usually we do about an hour. So a couple names that have been, pretty popular, but I would say maybe aren't getting as much attention. So LC, I don't think we necessarily touched on too much today. And in addition to that, also Disney, which is kind of obviously not your typical growth stock, but has been kind of seen more like, with the pivot, something along growth. So LC and Disney.
Yeah, I mean, I'm not in LC right now. I got stopped out of LC maybe 3 weeks ago, and I just haven't had a chance to get back in. I almost got back in a few days ago, but if you look at the charts, there's a gap going back to, I think it was Q2 earnings back in July. There's this gap on LC Lending Club from 1650 all the way up to 2162. And a few days ago, we started to close the gap. LC kind of dropped into that gap there. Obviously didn't fill it because it only got down to 2095, and like I said, the gap goes all the way down to 1650. So I sort of got nervous at that point. Even though LC looks really, really cheap, if you're looking at the fundamentals, and you can't really looking at LC on price to sales is not very accurate because their margins are way different than many other fintechs. But they do have a bank now because they bought Radius Bank a year ago, and that's helping them to lower their cost of capital. So I mean, LC, like, you look at the fundamentals, and there's a lot of reasons to love this company and believe that it's really undervalued. I know some analysts recently have cut their price targets. I mean, they had price targets in the 40s, 50s, 60s, and they've lowered their price targets, but most of them, still have a buy rating on the stock. So LC is expected to do like 1.1 billion in revenues this year, which is 42% revenue growth over last year, and 161 million in net income. With the current enterprise value of like 2,200. Let me just do some quick math. Yeah, 13 times earnings. I mean, the stock is, 13 times earnings. Now, looks a little silly. So they're expected. So last year, or 2021, I mean, I guess technically it's last year, although we haven't seen the final numbers yet. But it's expected that LC is going to do 26 million in net income, and then 2022 they're expected to do 161 million in net income, which is a 522% increase. So it's like insane. So, I mean, if you want to get like silly and do peg ratios, I mean, you look at a stock like this, that's trading at 13 times earnings with 500% net income growth. So, and even if you look at EPS, they're expected to generate $1.50 of earnings this year. Divide 24 by 1.5, so 16 times earnings, and that's on GAAP. That's not non-GAAP. That's not playing around with numbers. Like, that's actually GAAP number. 1.5 1.55 for this year. So probably closer to 15 times. So 15 times earnings with 500% EPS growth, 42% revenue growth. Like, there's a lot of reasons to love Lending Club. I mean, I'm a little mad that I don't own it right now because it doesn't look like that gap is going to fill, or hopefully doesn't fill. So I might jump in. It's just, unfortunately, these names that make most of their money or all of their money off lending. When you start to hear about rates going up, these are the stocks that get absolutely cremated. And unfortunately, the same thing happened with, SoFi and Upstart. They've all of these fintechs that are heavy on lending have gotten absolutely cremated. So, I mean, I think they all look pretty cheap at this point, but I don't own all of them. I don't own any of them right now. So I've gotten stopped out of all three of them: SoFi, Lending Club, Upstart. I'm not in them right now. I will get back into them at some point because I still like the stocks and the stories. I just have to try to figure out when I can get in. When some of the selling in these names is finally over. I mean, I don't think we've seen. I mean, it looks like we've seen capitulation in some of these names. I mean, most of them are down 60-70% from their highs. But, like we all know, the indexes haven't really, pulled back that far. So the big question is, if we see the indexes pull back or finally get hammered, or, the generals, as they say, if they finally get shot, does that mean that everything else has to come down too? Or do you then see money rotate out of the big caps into some of these smaller names that are down 70%? You just don't know. So, my guess is in the next couple weeks, before we get into earnings season, I'll probably get back into a couple of these names. Most likely, I would pick Upstart and Lending Club because I think they have the best shot at beating estimates, and I think they're both much cheaper than SoFi. SoFi unfortunately makes a lot of their money off of student loans, and unfortunately, that student loan moratorium is really hurting them. So, that was extended 7 or 8 months ago, until September, and then it was extended again until January. Now it's extended again until, I think, April or May. So, that's a lot of revenue that SoFi is losing because of that student loan moratorium, and that's still a very significant piece of their business. So I just think right now SoFi is off limits because of that. Now, the catalyst that could move the stock higher is if they get this bank charter. And there's a lot of reasons to think that the bank charter could come or should come in Q1. I just don't know if the stock will move off that news or if it's already priced in. So just hard to know. But in terms of, like, I think Upstart and Lending Club have the most upside going into Q1 earnings, because if we are going into Q4 earnings, because if we get some really good numbers, it's going to remind people that these stocks are very, very cheap. I mean, Upstart right now has an enterprise value of about 8.6 billion. The consensus estimates for 2022 revenues are just under 1.2 billion. I think they probably do somewhere closer to 1.4 to 1.6, but that's also assuming that their personal loan business stays strong. That's assuming that they're able to add more bank partners, and it's also assuming that their auto lending business is going very well. I mean, it seems like it's going well, but we really haven't gotten like any details on how well it's actually going. I think when we get Q4 earnings, we'll get a much better idea of how well auto lending is actually going, because investor relations has already told me that they're going to give 2022 guidance when they report Q4 earnings. So, we'll get a really good idea of how bullish management is on that auto lending business, because they're obviously going to have to bake that into their 2022 guidance. Now, what I'm partially afraid of is that they're going to sandbag the number. We've already seen Upstart report 4 times, I think, and every time they've beaten raised. So they sort of have a reputation now for beating and raising. Now, I know that, so I would sort of expect them to give conservative guidance and then plan on beating and raising again and again and again, because that's what they seem to, that's what they like to do. But I'm worried that if they give conservative guidance, the stock will sell off because of it. So it's just hard to know. I mean, just no idea how the market's going to react to, things like that. But we will get, and let me just double check. I think they're reporting February 15th. Let me just double check. I have like a whole spreadsheet. Tuesday, February 15th, after the close. So Upstart will report in like a month. So last year, because they went public in December 2020, they didn't report those Q4 earnings until like late March. So technically, they're reporting this year about a month earlier than they did last year. So, I'll get back. I mean, at least I'm planning to get back into Upstart in the next 4 weeks. I want to be in that stock when they report. Probably not a large, as big of a position as I had this past year. Maybe 3, 4, 5%. But I do think at these prices, at this valuation, for a company that's already profitable. So right now, based on current estimates, and obviously those could change in a month when the company gives guidance, but there are estimates out there. So we're talking 2022 net income for Upstart, and I've seen numbers anywhere from like 230 million up to like 300 million. And if that, like in that range, I mean, that means Upstart right now is trading at 30 to 36 times this year's earnings, 2022, and like 6 to 7 times revenues. So, maybe this stock was really overpriced at $400 a share, but I mean, I'd argue that it's really, really undervalued at these prices. Now, I think the company has done a piss poor job recently of landing new bank partners. I mean, they just announced a new bank partner like yesterday, the day before, and it's a $300 million bank. I mean, that is absolutely nothing. That's like a pimple on a mosquito in the banking world. So, they need to do a better job of landing bigger bank partners that can actually move the needle, like generate their own loan demand. Because that's where Upstart needs help. Right now, Upstart's spending a lot of money, on lead gen, on Credit Karma, commercials, social media ads. Like now I'm seeing Upstart commercials on CNBC all the time. I know they're doing ads on CTV like Roku, and those apparently are going very well. But, right now they're generating a lot of that loan demand themselves, and then they push those loans out to their bank partners, for anybody to underwrite. And then, of course, it's like FinWise and Cross River that are doing most of the underwriting, and then Upstart basically packages them up and sells them off to institutional investors. But Upstart needs bank partners that can generate their own loan demand on the personal side as well as the auto lending side. Although I don't know if the bank partners will really do much in terms of loan volume on auto lending. I think the plan is to have that come from the actual auto dealers. What they call Upstart Auto, I think that's Upstart Autos or Upstart Auto Loans, is the vertically integrated software that Upstart is now selling to these auto dealers, and then they're going to plug themselves in as the lending option. And I think the hope is that these auto dealers will now sort of do what Credit Karma is doing on the personal loan side. Credit Karma is obviously generating a lot of that deal flow for Upstart. I think Upstart's hoping that these auto dealers will now generate a lot of the deal flow for auto loans, and then I'm sure they're getting some sort of a kickback or a commission, on that loan demand so that they stay incentivized. So we'll see. I mean, Upstart will be an interesting. Like I think 2022 will be even more interesting for Upstart than 2021 because now we have auto loans on top of personal loans.
Yeah, that could be pretty cool to see. So we just hit 1 hour, Jonah. I'm flexible based on whatever your schedule is. Do you need to wrap up now? Or you got time for a couple more?
I got a few more minutes.
Okay. So a couple of others that I was kind of curious about. So one of them is Snow, which I know that we've talked about at previous calls at, higher valuations and wanted to hit lower. And then the other is SE.
Yep. So I'm not in Snow. I'm not in Snow right now. I got stopped out maybe a week and a half ago. It's obviously a name that I like. I'd like to get back in, but it's certainly not a cheap name. It still sells at a pretty rich multiple. I mean, I would put names like Datadog, Cloudflare, Confluent, Monday.com, Asana. I mean, all great companies growing revenues at 50, 60, 70, 80%. But, most of them still don't have earnings. So they're still trading at multiples on sales and, 20, 30, 40, 50 times sales, is still a serious liability in this market. So, I'm not in Snow right now. I'd like to get back in at some point. I just don't really know when. It's just not the kind of name that I'm looking to own right now because of that, that rich multiple. So, I mean, let me just look at the market cap. So enterprise value is still about 90 billion. this upcoming year they should do about 2 billion in revenues, I think. So they're still trading at 45 times sales. I mean, that's rich. I mean, I know it's a great company. I know they're growing very fast, but that still scares me. I mean, same thing with like Sentinel One. I mean, Sentinel One in terms of cybersecurity, they're the fastest one. They're the fastest growing public cybersecurity company, but they're also trading at the richest multiple, and they're also losing a lot of money. I mean, they have horrible operating margins right now, and obviously there's room for improvement. But if growth stocks continue to struggle once rates start to go up, I just think those are the sort of names that are just going to kind of lag behind. So for cybersecurity right now, I own CrowdStrike and Palo Alto Networks. Palo Alto is very profitable. CrowdStrike is, I think, technically profitable. Maybe not on GAAP. I think non-GAAP. But they're certainly trading at way more reasonable multiples than Sentinel One. And then for cloud stocks, let me look through my portfolio and see what I'm in. I mean, C Limited. I don't really. C Limited is more e-commerce. Yeah, I mean, I really don't have that much cloud and software in my portfolio. I mean, Booking.com. I don't know if you. I mean, I guess technically they're a software company. I mean, they're obviously in the travel space, but I mean, the risk for them obviously is the pandemic lingers. We get more variants in 2022. After Omicron, it's something else, and people can't go back to their normal traveling behavior. Then stocks like Booking.com, Expedia, and Airbnb will all struggle. But if travel does start to come back, a stock like Booking.com is really, really cheap right now. I mean, I think analysts are expecting like 40% revenue growth this year, and the company has like 40 or 50% net income margins. Let me just double check. 26% net income margins. So I don't really count that as a software name or not. I mean, I did take a couple swing trades this morning or this afternoon. So when Confluent was down 10%, I started a position, but I got stopped out. So I got in at 66. I got stopped out at 65, and I also took a swing on Cloudflare. So if you look at the chart on Cloudflare, it's found support right at $100 a couple times. Most recently, like a week ago, it bounced off of $100 almost to the penny, like literally bounced at 100.01. So like within a penny of $100, it bounced, and then it rallied almost 20% from there. And then yesterday it got rejected at the 200-day SMA, and now it's back down at almost $100. So I got into net this morning or this afternoon at 102. I added again at 101. I got another small order at 100, and then I got a stop loss at 99. So, because the last time we were around this level was back in July, and we bounced off of 99.51. So if we can't hold at 100 and we can't hold at 99.51, then I'm out of the position with a small loss. So I mean, like, these are not names that I have a high conviction in. These are not names I'm looking to build big positions in. But if I see some of these, these growth stocks pull back to support levels, I might start positions right near that support level with a stop loss right below. And if we get another bounce, 10, 15%, like we did this week in some of them, great. I'd probably trim into that bounce. And if we just keep going lower, then, I'll get stopped out and, maybe look for a better entry in the future.